Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Phil, welcome to this very special episode of the podcast, mate.
Thanks for having me.
We are doing this as part of a mini-series. We have 6 episodes in front of us, and we're going to be talking about insurance, and in particular personal insurance, which we'll help people understand shortly. Through meeting you, it's been great. I've learned a lot about things like income protection, about so many different types of insurance, and you've kind of debunked some things that I've learned over the years, even when I was studying to be a financial planner and doing all of that, some things that obviously this is your speciality. So I think people are going to get a lot from these episodes, and we're going to try and keep them concise and snappy. But I guess the first thing that people might want to know is you and the team at Skye, like you have many wonderful advisors in your team now. You guys specialize in insurance. Even though you are financial advisors, that might take some time for people to wrap their heads around, because normally when they associate financial planning, financial advice, it's like there's super, there's tax, there's banking and cash flow, and there's all these other things that come in with what a financial planner might do. But you guys have chosen, and you in particular have chosen to focus on insurance. So I'm curious, and I'm sure the listeners would be curious to know why you decided to do that.
Yeah, well, it is just to go behind the scenes in financial advice. It is a little bit zigging when others have zagged. That the level of advisors providing insurance advice has decreased significantly. I think there was a stat last year where 50% of all insurance that comes through an advisor is written by less than 500 advisors in the market. So it is a shrinking market.
Wow.
And I was a holistic advisor. So holistic meaning that we all kind of look after, super investments, insurance as well. And then we decided early, not early, I'd been in business for 8 years. But in around 2020, we moved towards insurance-only advice. And kind of the core reason, I saw there was a lot of advisors leaving that market. But also I personally had been a little bit disenfranchised with the advice market and being an advisor where the majority of people we help serve are the wealthier people, just because of the cost to serve clients was really high, and we have to charge that much. And so therefore, the everyday Australian can't really access holistic financial advice en masse, and it was difficult. So I'm passionate about educating and empowering clients to make informed decisions about financial products. And the area in which we can still do that for a lot of people was insurance. And the reason being is because we get paid a combination of fees and commissions from insurers. So it's kind of like mortgage broking is still accessible to the masses because of that funding mechanism. So that's kind of why we moved into insurance only. And the more we did it, the more we realized how much more difficult it is, how much more specialized you need to be. I was talking to someone today, the more specialized you get, the more you realize you don't actually know as much as you thought you did.
It's interesting because most people probably don't think about this as much if they're not used to financial advice. But normally when someone comes to a financial planner, you can get pretty straightforward common sense advice. But there are some areas where it's not straightforward and it's not common sense. And one of those things is where medical history mixes with finance, which is, I would say, in my opinion, it seems like the most complicated and most nuanced part of financial advice, but also just life in general is medical. I mean, who knows really? But I've told a few people, because we've obviously now established a partnership between Rask and Skye, which I'm super excited about. But I've told a few people recently that I'm going through the insurance process with your team. And obviously someone like me, I studied financial planning. I've been in the industry for a long time, like in investing and finance generally. But even for someone like me, going to see you, they've kind of been like, why wouldn't you just do that yourself? And I'm curious, like, when people ask, like, would have similar feedback. So I'll put the question to you, like, why would I pay the Skye team to do it for when I could probably do it myself? That's the question, I guess.
Yeah, there's a lot in that. I'll try and unpack some of it. So as an everyday consumer, there are limitations on how many insurers will sell you their product directly. It's not like mortgage broking where you can go to Commonwealth Bank and buy their mortgage product, or you can go to a broker and buy their mortgage product. Most insurance providers in the market, and there's not a big market, they distribute their products either through a super fund, and so they do a big group policy through that super fund, or through financial advisors. There's only really two. There are more who do direct, but two real ones, and by real I mean not junk policies, who sell direct. So there are other insurers who are big insurers, and they, in my opinion, don't sell great products direct. But there's only really two out of the whole market that do sell direct. So as a financial advisor, we've got access to more products. But the other option is going to a broker. And so a broker is, you can do a quote online and you can self-select which insurance provider you want. And the reason why that can be beneficial for some people is you know the cost of that product up front, and you can get a good sense of what's going on. The reason why we give personalized financial advice is we want to make a recommendation based on your medical history. So a big part of insurance is about tailoring the advice and the recommendation to someone's personal medical history. Because, over all the insurers on the market, you may have one medical history that one insurer says we're going to provide an exclusion on that policy or a loading, which we'll touch in detail in later episodes what that means. But another insurer may say we're not going to put an exclusion or loading on. And as a consumer, if I'm just doing a quote online, I won't know the difference between that. But as advisors, what we do is we gather a lot of medical information up front, gather a lot of financial information up front, and we will let people know this is the level of cover that we recommend. These are the expected exclusions or loadings or terms of the policy, and here's the cost of the cover. And so that's why, obviously I'm biased. This is my business. This is what we do. But I'm a big believer, even if they come through us or anyone else, you should be looking at getting financial advice when it comes to insurance.
Yeah, well, you said that even off air to me before, that you want more financial advisors to do it because it would be good for consumers, which is quite interesting. You don't often hear someone say that other people should do what we do because it would be better for everyone. It's quite interesting because we're going to get to it. We've got the episodes. I should have started with this at the top of the show. We've got this one, which is talking about an introduction to personal insurance and what we mean. We're going to talk about lump sum insurances and what that means. In episode 3, we'll dive into income protection. Number 4 is about the different ways that you can buy the types of insurance that we're talking about and how it may not be a huge out-of-pocket expense for people, at least not what they think. We're going to talk about the application process, what to expect when you get insurance, what it looks like through an advisor, the best practice. We're going to talk about how do you do ongoing, how do you do a review? If you're already in a policy and you already think that you're protected for certain things, maybe that's not the case. So Phil's going to talk us through that. And finally, we'll talk about the kind of the last stop on the insurance destination, which is often where there's a claim made. So you'll talk us through that as well. But one quick follow-up before we get into the topic, which is how you can explain what personal insurance is and what it isn't. How do you charge? So I asked about like I say, I'm going through the process. So I know, right? I'm about to pay the bill. But how do I pay you as a financial advisor that specializes in insurance? How have you structured that?
Yeah, so how we get paid as a business, we charge an initial fee for an advice fee. So it's financial advice. It's at the moment anywhere between $330 and $770, depending on if it's an individual, a couple, and if you're self-employed, there's a different cost structure there. And that pays for our advice and all of our research. So we will ask you 1 million questions up front about your medical history, financial position, and then we'll go and take that to the insurers. We'll scrub your name out of the information so it's not personally identifiable. And then we get an indication of what that would look like if we submitted an application. And then we provide advice. And so that covers the cost for that. Now, if you, Owen, decide, actually, I don't want to go ahead with this, or I've decided to change my mind, and you walk away, there's no other cost. We charge you that initial fee. And if you do decide to go ahead with the policy, then we get paid a commission from the insurance provider to set up that policy. So that funds that application and the ongoing management of that policy.
Okay, good to know. And for what it's worth, it seems totally reasonable to me. Obviously, I'm going through it. So the topic for this episode is about personal insurance. And the reason why we wanted to start here is because there is a bit of a lot of misunderstanding about what it is when we talk about personal insurance, what it means, the definitions. People might be familiar with other types of insurance. So where do we begin?
Yeah, so personal, all right, let me just talk about the insurance industry. I went too deep and did some research last week about I won't go too much into this episode, but there's really 3 different categories of insurance that we all know. So there's general insurance. So you think about car insurance, house insurance, travel insurance. That's all categorized under general insurance products. Then you've got health insurance. So a lot of people watching this would know about health insurance providers. So that's when you've got a medical bill and they'll rebate 60%, 70% of the cost. And that includes hospital cover in that. So that's health insurance. Now, personal insurance is all about individualized cover. So I want to insure my own income. I want to insure my life. I want to insure myself if I'm disabled, if I have a traumatic event. That's under the personal insurance, and they're all legislated in different ways. And so we are talking about personal insurance. One of the great things about personal insurance is once you set up a policy, the insurance provider can't cancel that policy on you unless you don't pay your bill. And so that's protects anyone who goes on claim and then comes off claim. The insurance provider can't kick you off that policy because they've got to maintain that policy if it's something like income protection. So that's kind of the legislative areas of insurance. And so, that's what we mean when we talk about personal insurance. We're going to go in deep about life insurance, so otherwise known as death cover, TPD, so total permanent disability, trauma insurance or critical illness, income protection, and child cover as well. So that's what we are talking about when it comes to personal insurance.
Child's cover is something I hadn't actually heard of until you put it in the notes. So I'm interested to know what that means. So basically, I was writing this down. We've got general insurance, which is like car insurance, health insurance, which is like people see the ads everywhere.
Yeah.
And that's like hospital and extras if that's bundled in there. And then we've got personal insurance. And the interesting thing there that you said is that's like life insurance, TPD, income protection, and child's cover. You said that the insurer can't cancel it. Can you just double click on that and give us a reason why that might be the case?
So there's a little bit of nuance, but I'll just say if you've got your own policy direct with the insurer, they can't cancel that. So if I am injured, I've got an income protection policy. If I injure myself and hurt my back and then go on claim for 12 months, the insurance company will pay me a monthly benefit to cover my income loss if I'm not able to work. Now, once I go off claim and I'm back at work, the insurance provider has to maintain that policy. So I then start paying the premiums again. And if I need to claim in the future, then they can't retrospectively say, well, actually, we're cancelling your cover now. And that the reason why that's different, general insurance products, if you have a car crash every month for 2 years, the car insurance provider can say, we're no longer willing to offer you cover. You're too high risk. It's costing us too much. We're going to not offer you this cover anymore. But under the Personal Insurance Act, under the Life Insurance Act, they're not allowed to do that. They're not allowed to negatively impact you based on their claims.
See, that's really reassuring for people, and people probably don't understand that nuance. Like I've heard of many people like with general insurance, like in flood-prone areas where people have really bad experiences with their insurance. And a lot of the times that people would argue that that's just the risk of insuring something, right? So that's reassuring to people, particularly I've got family members that have had a couple of bouts of cancer and have different things that are like obviously existential, but also financially, like they're huge, huge responsibilities. And they're, it's been interesting to see that play out over the years in real life. When I say interesting, obviously it's traumatic for people, but it's good to know that that system is in place.
And the thing, just to touch on that, general insurance, every year it renews, they could change the product on you. So they could offer flood cover, but then over years decide, well, this area of Brisbane, let's say,
that's
is
the one I was thinking about.
Yeah, of course, is more prone to floods because of their experience. So we're going to remove that from the policy moving forward at the next renewal. Under the Life Insurance Act, they can't retrospectively change the policy on you.
Yeah. Okay, that makes sense. So because we're going to talk about these things both at a deeper level, but also just generally probably as throwaway lines, I think it's really important for us, or for you, if you can, provide that broad overview of the major types of personal insurance. So just generally, what are they? What do they cover us for? Obviously, we're going to talk more about the lump sum insurance, which we'll categorize in a moment in the next episode. And then the one after that, it's about income protection. So, but let's just get us on like the first base. Let's just understand what they are and when we talk about them at a high level.
Yeah, cool. So, I mean, at the end of the day, insurance is about you pay money to an insurance company. If an event happens that you're insured for, they give you money accordingly. So lump sum cover, which is our next episode, that talks about life insurance or death insurance. So if you pass away or you're terminally ill and unlikely to live more than 12 or 24 months, then the insurance company will pay a lump sum payment that's a death payment. Most people are familiar with that. We've got some understandings. Your super fund may have that. And so that's death cover or life cover. I always call it life cover. The next one in that lump sum category is total permanent disablement. So if you're totally disabled and you can never return to work again, then they'll pay you a lump sum payment as well. And then the third one is trauma or critical illness. I'll always refer to it as trauma, but there's like 3 different names across the different insurers. It's ridiculous. There's like 10 insurers in the market and they've got 3 names. It's the same product, but basically there's specific medical events that you can claim on. So the majority of claims is for cancers, heart attacks and strokes for that type of policy. But there's a list of a whole bunch of conditions and based on severity that you'll get paid a lump sum if you have cancer, for instance. And then the last one in that lump sum is child's cover. So that's kind of a mini life and trauma policy. So there's like less conditions that it'll pay out on, and for terminal illness and death for little ones who are older than a certain age, they can get cover, and generally younger than 18.
Do you have to, so if you're a parent listening to this and this is the first time you've heard of it, is that something that like is common and people should investigate?
We recommend it. I'm a big believer in it. I've got it for my kids. And so we recommend it to clients. At the end of the day, our job is not to tell anyone what they should or shouldn't do. Our job is to educate people and empower them to make the choice that they're comfortable with. So we recommend it because, the insurance is all about what happens to you individually. So I won't get paid anything if my kids are sick on my personal cover. So we have a policy on their life. If something happens to them, we get paid a lump sum payment so we can take time off work. So yeah, some people, and we respect anyone's position, but some people feel uncomfortable. Well, am I going to benefit off my child falling, critically ill? Well, no, you're not going to benefit because they're critically ill and you're going to want to take time off work, and it has a massive impact on your financial security, having that time off work. And so that's really what insurance is about, protecting that downside risk. We can all get really excited about our future investments, we're buying an investment property or buying our home, and that's all really exciting about that future. But as soon as a medical event happens to you or one of your loved ones, then it has a massive impact on our kind of financial, future.
Oh, absolutely. I don't know why I have never heard of this. This is big.
I finished my master's in financial planning, and there's very little on insurance.
Yeah. How old do children need to be normally?
So different insurers have different ages, but the minimum is they need to be over age 1.
Okay.
So baby little ones won't be able to get covered because of, from an insurer's point of view, there's too high a risk that something's going to happen. But from 1 to 18 is generally when you can get covered for.
Oh, okay. That's good to know. For any parents out there, go and investigate this and see if it's something, and speak to the Skye team. That's really interesting. Thank you. I'm just going to I don't, at risk of turning this into a Jordan Peterson podcast, I'm curious to know why you prefer to call it life cover. For me, maybe I'm just a pessimistic person, but I do like to refer to it as death cover because that's what it covers you for. Why do you say life cover?
I think most insurers call it life cover. I think that's why, but also like income protection is not called loss of income protection.
Yeah,
it's called income protection. So I don't know. I don't think too much about it. We generally try and tell clients, hey, it's death or life, because they will come from, most people see it in their super fund, and different super funds will call it death or life.
Yeah, interesting.
Yeah.
That's fair. I just was, because I'm sure people are like, yeah, it's a funny little quirk of our industry.
Maybe death sounds worse if you're trying to talk about the need for it. Because our job, as insurance advisors, it's a pretty morbid topic. We're talking about like severe issues, and we've made a business decision not to ever try and scare anyone into getting insurance. It's not about like scaring people, and that can be go get funeral insurance because you're going to need it or whatever. Like, we've tried to make sure we are very clear about what we do and what we don't do in our client engagement, and so I'm personally a very pragmatic person, and I want to talk about educating clients and then just let them make an informed decision. So I guess life insurance sounds better and sounds less kind of scary. You better go get it because you may die, as compared to death insurance. But I haven't thought too much about it. But
yeah, that's fair. So there are just two more things that I want to ask you about for this first episode. We promise we'll keep them kind of snappy. Is some of the myths, like I think this is probably the most, maybe super, you could say. There are some pretty dangerous things that get thrown around in finance in terms of people's drastic misunderstanding of really important points. But I feel like when it comes to insurance, and particularly the types of insurance we're talking about, believing in something that is literally a myth that you might hear at the footy club or when you're chatting to your girlfriends on the weekend, like, there are some things that people should probably be corrected on. Are they common misconceptions, I should say, or just myths that you might come across? If you don't have any, that's cool, but I'm just curious to know.
No, I mean, I've got plenty.
Okay, go for it.
I think insurance is very misunderstood because it is the smallest area of insurance in the Australian market. Makes up a very small portion of the overall insurance market. But also there's, a lot of people don't actively go and get it unless they need to, and they think about the buying decision once. So some of the myths I would talk about is there is a myth that it's more expensive to go through an advisor because we get paid a commission. And that is a big myth. In the past, it may have been the case. Some super funds, and I'll go deep here, and I know we don't want to make it snappy, but I'll go deep. A lot of super funds had there was 35 million members of super funds, but there were not 35 million Australians at working age. It's because there was multiple super funds. They all had default insurance policies set up. So super funds used to be cheaper to get cover because there were so many members, like double premium paying members. Now, the government made some changes and legislative changes to stop that. So only members who are active members of a super fund are paying premiums now. So all the premiums have gone up significantly. So that's one big myth that has been perpetuated a lot is that it's actually more expensive to pay your premiums through an advisor because of the commission. Now, that's just not the case. I kind of keep getting sick of seeing it. And, in our analysis, we now analyze everyone's policy that they're coming from. And we went back and looked at 500 of our clients and said, I want to do a new fresh quote, the insurance provider we recommended versus their super fund, whatever their super fund is, whether they've got cover or not. And it was on average 33% more expensive to increase through their super fund than it was to go through the advisor. And we don't choose the cheapest one all the time because for health reasons, we make a choice for our clients. So that's the big myth. Hey, it's actually not cheaper. It's not more expensive to go through an advisor because of that commission model. And again, I can go in. We can spend 45 minutes on this topic, but I won't. The other myth is that people think that it's either go through an advisor and pay my premiums outside of super, or go to my super fund if I want my super balance to fund the premiums. And that's also another myth. You can go to an advisor and they can set up an insurance policy that's paid from your super fund without the need to move super funds. So you don't need to move from a Host Plus or an Australian Super account to set up any insurance policy you want. So that's one thing. If you go direct to the super funds, they've only got one insurance provider that they contract to. But if you go to an advisor, they can pick whichever insurance provider is best suited for you and get your Australian Super fund to pay that premiums.
It's 33%. I don't think I've heard you say that before. So when Glenn James, it wasn't Glenn coming on our podcast. We were on his podcast. I was talking about this because I hadn't heard this. And I was like, this doesn't make any sense, Glenn. I've been trained again and again and again to use my super fund and to talk about that. But the time we were talking about it, I think the rules were changing, as you said before, with people having multiple super funds and whatever, and the way that the industry was kind of cleaned up a bit. So that's really interesting. And also the second bit, which is that you may be able to use your super to pay for insurance, but you don't have to necessarily accept just what Australian Super or whoever else the super fund might be just gives you. Now I was actually going to ask about both of those things in future episodes. So we will go a little bit deeper then. But I'm definitely one of those people that like, insurance is cheaper through super. I'll just increase it as like to the limit that I want, and Bob's your uncle. But there are multiple reasons that might also be risky. So we'll come to that in a future episode as well. On the back of each of these insurance episodes, mate, I did want to ask you for one action point, because people can get overloaded when it comes to insurance. Like it's already overwhelming talking about all the other stuff, but insurance in particular is also overwhelming. So I just wanted to break down at the end of each of these short episodes, one thing that people could do, one thing people could plan to do, one thing they could think about, just one thing that people could take away from this discussion and hopefully make a more informed decision from this episode. So what would that be, Matt?
I mean, for me, just based on this first episode, is just understand what you've got today. That's my first takeaway. Go into your super fund, log in online and click on the insurance section. A lot of people think that they've got cover and the super fund's got it sorted, but just be aware of how much you've got. The default level of cover within super is often really low. And if you've got your own individual policy that you've set up through an advisor or somewhere else, just check how much cover you got. That's kind of my number one takeaway on this first episode. Just be informed about the level of cover you've got today or don't have.
I like it. So just be informed. Just know. Really. I feel like I'm so glad you chose that as your first thing. I've had some people recently, I won't go into specifics, but I've had a lot of people, like I'm 33 years old, Phil. We talked about this off here. And when you're 20s or 30s, you think that you're bulletproof, or at least, there's like a few jokes about this. Like when you turn 30, you're basically 20, but you've got money. But that's not the case anymore, right? Like now all of a sudden your responsibilities increase, but also you begin to get more life experience and you begin to realize that people are vulnerable to the fittest person that getting cancer or whatever. I know we're not trying to fear, because that's not what I'm trying to do. But when I hear of people in my friendship groups getting sick as a finance person, the first thing is like, oh my God, I hope they just checked if they had insurance, just even looked. Like the amount of, and I've had that in the last few weeks. So great way to start is just be aware of what you got. Log into your Australian Super or your whatever you got. Go check the files, the email that you receive, see what you've got, see if it might still be appropriate. You'll always be able to find a link to Skye in the show notes. You can go through our onboarding form as well, and it takes you through and sets you up with a call from the team at Skye. So, Phil, this is lots of fun. In the next episode, we're going to talk about the lump sum insurances. We're going to go a bit deeper into death/life and a few other things. So I look forward to that one. But, mate, thanks for joining me for the first episode.
Thanks, Matt.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.